Okay, so for this video, we're going to be focusing on lesson 2.3, solving problems involving credit. So by the end of this lesson, you should be able to analyze, using technology, different credit options that involve compound interest, including bank and store credit cards and special promotions, and providing justifications for the credit options. So there's different types of credit cards you can get. You can either end up getting them from the bank or the store. So for example, like Walmart has their own credit card, Canadian Tire has their own credit card. There are different types of bank credit cards you can get. So there's prepaid cards. And so those ones already have X amount of money on them. And then once the money's run out, it's done. There's reward cards. And so those ones earn you different points, benefits, money, or merchandise. So for example, I have a rewards card. So every dollar I spend, I get a point. And then I can use those points to go to hotel rooms. I can get different um, stuff like an Xbox, anything like that. There's also low interest cards you can get. A couple things to know about credit cards is you must pay a minimum amount each month based on the percent of the balance. If the balance is paid in full by the payment due date, no interest is charged. If a credit card does not have an outstanding balance and it is used for a single purchase, it can be treated as a loan and you can make regular payments. Always determine the full cost of borrowing before making a decision about what type of credit to use. And incentives and promotions are offered to entice consumers to use credit. Other things that you can get is called a line of credit, so a pre-approved loan that offers immediate access to funds up to a predefined limit with a minimum monthly payment based on accumulated interest. So basically, a line of credit, you might get a line of credit for $10,000. If you don't touch it, you don't pay any interest on it. But if you start pulling money out of the account, then whatever you pull out, that is what you start paying interest on. Um, a note when you get a line of credit, or this also applies to things like government student loans, things like that, is you have this Bank of Canada prime rate. So that's a value set by Canada's central bank, which other financial institutions use to set their interest rates. And so a lot of times you'll hear is like this plus prime, so like 1.7 plus prime. So it's their interest plus what the Bank of Canada sets, and that's added together, and that's the interest rate you're going to be using to calculate your loan. Other things you can get is a payday loan. So this is a short-term loan from a business, not a bank, and the payment is usually due on your next payday. A large fee is charged, which makes the interest rate very high. So yeah, there's different businesses out there. If you drive around Regina, you'll run into a bunch of them, and basically you go into them, you say, I need X amount of money until next payday. They give it to you, but then they charge a large fee. So it's honestly not the greatest option. And then the other thing you can get is a cash advance. So that's a loan of cash from your credit card balance. A higher interest rate is usually charged for a cash advance. So basically, this is like pulling like physical money out of your credit card. And if you do that, you're going to pay an arm and a leg for it. So for example, we have Meryl and Kyle are buying furniture worth $1,075 on credit. They can make monthly payments of $75 and to have two credit options. Which option should they choose? So we'll worry about option A to start with. So for option A, we have a store credit card offering a $100 rebate off the purchase price at an interest rate of 18.7 compounded daily. So I'm going to take the cost of the furniture, so the $1,075, and I'm going to minus the $100 from it. And so what I'm actually getting a loan for is $975. So now I'm going to go to my financial calculator. And so double checks that my long period option is amortized, so that's good. Okay, so for this, our loan amount is the $975, which I already have typed in. The number of payments is going to be unknown. We don't know how long this is going to take. The annual interest rate is this 18.7. My payment amount is $75. And so then I'm paying monthly payments, so my payment frequency is monthly, but the 18.7 is compounded daily, so I'm going to put in daily. I'm going to go to my options, and since I am paying monthly, then my dates need to be a month apart. I'm going to hit calculate, and we get that our final payment is this $1,000, $1,099.23. And then we're going to do the same thing for option B. Option B is a new bank credit card with an interest rate of 15.4% compounded daily and no interest for the first year. So what we're going to do for that one is we have to figure out how much gets paid off before we start paying interest. So we're paying 75 bucks and we're doing that for a full year each month, so 12 months. So 75 times 12 is 900. So I'm going to take the loan amount minus the 900 because we're going to pay that without interest. And so we're left with 175 bucks at the end that we have to use the interest calculations on. So we're going to do 175. Our number of payments is unknown. Our annual interest rate is 15.4. Our payment amount is 75 bucks. We're doing monthly payments. It's compounded daily. Our options are our dates need to be a month apart. It calculates. And it works out to be that I'm going to pay this $178.60. Is the amount of money I pay. And so for the total, I'm going to take 178.60 plus the 900 that I already paid. And so we're left with $1,078.60 is what you end up paying altogether. So for this one, the better option is going to be option B because you end up paying less. So option B is better because you pay less.